again with the derivatives and related accounting issues. In this video, we will move to discuss learning objective number 7, demonstrate how fair value hedge is used and account for such hedge. As we discussed in previous videos, we have different types of financial derivatives or derivatives instruments. May we entered into a future contract, forward contract, interest rate swap, etc. Now the point that we are going to discuss, suppose we entered into a future contract to protect ourselves against the fluctuation of inventory that we sold or we will deliver it in the future, or we entered into future contract to protect ourselves against a product that we will receive in a certain period of time in the future. Let us see how or what's the accounting treatment of fair value hedge. But before that, let us discuss the criteria of fair value hedge. First of all, there is a critical criterion is that an entity must consider when they entered into forward contract, or when we talking about special fair value hedge accounting. Now, first of all, we must have formal documentation to document the transaction, and we have to entity risk management, or we have to determine the entity's risk management objective and strategy. We must indicate the reasons for undertaking the designated hedge, identify the hedge item and the derivative hedge instrument. First of all, we have to determine all of these points before entered into special fair value hedge accounting. You have to determine all of these points. Otherwise, if you don't consider these items or these points, or you didn't determine it before you entered into forward contract, or before you follow the procedures of special fair value hedging, the point is this criterion must be satisfied at inception. It means you have to, or it should be predetermined before entered into this kind of a transaction. Again, this criterion must be satisfied at inception, means predetermined, and cannot be retroactively applied after an entity has determined whether hedging would be beneficial. It means you have to first of all determine these points. You have to satisfy it at the inception point, then you can move to apply the special fair value hedge accounting. Otherwise, you cannot apply it. Let us see the example or accounting example or numerical example to discuss this point. Here we have an hog producer has an inventory of hogs on April 1st. The producer decides to hedge the fair value of the hog inventory by here the point already we have the inventory. To protect himself against the fluctuation of the prices of hogs, he decided to acquiring 2 July futures contract to sell hogs. Each contract has notional amount. As we discussed before, you have to determine the notional amount of contract. Here we are talking about 40 pounds. Each contract has notional amount of 40 pounds. Here we are talking about 2 contracts, so in total we are talking about 80 pounds. At 0.65 per pound, the future contract per pound is 0.65. Assume the contract are settled on July 15. After we have passed April, May, June. On July 15, we have settled the contract. Let us see what will happen. It's assumed that the term of the future contract and the hedge assets match with respect to the delivery location, quantity, and the quality of hogs. Margin amounts and the broker's fees are ignored here in this example. Margin amounts and the broker's fees are ignored for purpose of discussion, for purpose of simplify the example. On July 20, the producer sells 80,000 pounds, the amount of inventory that he holds, of hogs at the current market price of 0.611 per pound, and offset the contract. Assume that the producer's carrying basis book value of the inventory, we mean $40,000 before any adjustment related to the hedging transaction. Now the point is, because we fear from the fluctuation of prices, or in this, especially in this example, we fear from dropping the prices or decreasing the prices, we entered into a future contract. Let us see the detail. Here, this is given data. Here the pounds, we are talking about 80 pounds in total in April 1st, May 1st, June 1st, July 15th settlement date. We are talking about the same amount of a quantity. The spot rate on these dates are as follows. On the date of agreement, when we entered into future contract, the spot rate means the current rate, the price that I can sell by on this date. On April 1st, the spot price 0.64. On May 1st, we can sell on May 1st and deliver on May 1st by 0.62. On June 1st by 0.62, 622, by on July 15 by 0.610. What's the future price per pound? Future price on April 1st was 0.65. Future price means when I entered into forward contract on April 1st to settle on July 15, the future price were $0.65 per pound. A future contract for the same contract on May 1st, when we are on May 1st and we entered into forward, the same forward contract that to settle the future, to settle the contract on July, or in the future on July 15, the future price is $0.635. A future price on June 1st to deliver or to settle the same contract in the future on July 15 is 0.624. Here on July 15, the future rate equal spot rate. Doesn't make sense to have different prices on the same date. On July 15, if spot rate equals a future price. Let us see how can we calculate the amount of gain or the amount of loss. Let us see here. Here we are talking about two transactions. First one, holding the inventory itself as it associated to a future contract. Here we will calculate the gain or loss of holding the inventory itself and gain or loss of entering into forward contract. Here, because the inventory is associated with a future contract, we will calculate the amount of gain or loss because of the fluctuation of the prices to the amount of inventory. On the other hand, also to the amount of a future contract. As we didn't enter into future contract, as we used to evaluate the inventory, we don't need to calculate the fluctuation, and we will follow the normal procedure of evaluating the inventory. But as the inventory is associated with a future contract, in this case we have to evaluate the future contract according to the fair value. Also the inventory will be evaluated according to the fair value because it's associated to the future contract. Here, how we will calculate it? Look at this different prices. On the date of agreement, we entered into future contract to sell our goods by 0.65. Here, usually when we sell goods, we entered into future contract because we fear of what? We fear from the declining of the prices. Okay? Here, we entered into future contract, we entered into future contract by 0.65. In the future, after 1 month, the future contract price declined into 0.635. Here, we entered into future contract. Already we have signed it. We have entered into 0.65. The prices in the future dropped into 0.635. The question is, did we get gain or loss? The point is, already we have sold it by 0.65, but the prices has been dropped into 0.635. So here in this case, we are talking about gain because we will earn 0.65. Otherwise, if we didn't enter into this future contract on that date, April 1st, and we entered it into 0.635 on May, April, we will earn this amount. So, because we entered into it on April 1st, we will earn this amount, 0.65. So here we are talking about the gain because we will earn this amount. The amount of gain equal 0.65 minus 0.635. We are talking about 0.015 multiplied by the quantity. Here we are talking about 2 contracts. Each contract has notional amount of 40 pounds. In total, we are talking about 80,000 pounds. So the amount of gain, because we have entered into future contract here, 1,200. Okay? Let us calculate the amount of gain or loss because of holding the inventory. Here the spot rate, the current rate on April 1st is 0.64, and we hold this inventory. Still we hold it. The spot rate on May 1st after 1 month has been dropped to 628. Inventory, we hold it as assets by 64, and the prices has been declined into 0.628. So here we are talking about loss because the inventory that we hold, the value of it has been declined from 0.64 to 0.628. So the difference here, 0.640 minus 0.628, we are talking about multiply by 80,000, the quantity 80,000 pounds. Here we are talking about 960. So we have loss because we holding the inventory and the prices has been dropped from 0.64 to 0.628. So here, because of holding the inventory, we exposed to amount of loss by 960. So you have to record this amount. How we will record it? Loss on inventory, and this loss has been occurred because holding the inventory. So the amount of inventory will be declined by this amount of loss. Loss on inventory 960, inventory of hugs 960. Okay, this is first part. Here we will record the transaction, or we will discuss accounting for inventory and accounting for derivatives, all of them together. Let us move to calculate to record the amount of gain. Gain because of holding the future contract. Here we have amount of gain by 1,200. But here this amount is divided into 2 sections because of the changing in spot rate and because of a change in time value. what's the amount of a changing in time value? Here we are talking about the change or the difference between a future price and the spot price, 65 and 64. 64 minus 65 multiplied by 80,000. Also, the difference between 628 and 635. Here we are talking about the changes in time value because of the difference between a future and the spot price on the date of agreement, a future and spot price on the date of preparing the financial statement. Here we are talking about 240. So the 1,200 occur because of current period change, the difference between spot price and the change in time value, the difference between future and the spot on the date of agreement, future and the spot on the date of preparing the financial statement, or we can record it together by one entry for simplify the idea here. Because of the future contract, we have earned 1,200 as gain, so we can record it by the following entry: a future contract 1,200 debited, gain on a future contract 1,200 debited, or you can separate it 960 to record the change in value of the contract included in hedge effectiveness, and 240 debited for the future contract, gain on a future contract to record the change in time value excluded from the hedge effectiveness. Or you can record it as one entry: future contract by debited by the total amount 1,200. On the other hand, gain on a future contract credited by 1,200, the amount we have calculated here. Or you can record it by showing the detail of the amount. Let us move to the next month. Here in the coming month, the future rate, future price also has been declined from 635 to 624. Here you have to calculate the difference from 635. Already you have adjusted it from 650 to 635. Here we need to adjust it again on June 1st from 635 to 624. Already we have adjusted it by 635. Again, the amount has declined. So in this case, the amount that we have sold it is 6.5. It has been declined to 624. It means we have generated a profit, or we have gain in this case, because we have sold by 65, but the prices has decreased into 624. So in this case, we have gain by 2,080. The difference between 65 and 624, here we are talking about 2,080 in total. But be careful, already on May we have recorded 1,200. The 1,200 included here in the 2,080. So the amount occurred in June is 880. The difference between total amount and the amount occurred in May. You have to deduct it because already you have recorded it. So the amount occurred in June is 880. In total, the difference again is 280, but already 1,200 from this amount is recorded in May. So the occurrence amount in June is 880. This is the gain of a future contract. How we will record it? As one entry or two entries, separated two entries. To simplify it, record it by one entry. Future contract in total 880 debited. Gain on a future contract debited by 880, or you can separate it like this one to record change in value of contract and to record the change in time value excluded from this amount 480. Or you can calculate, or you can record these two entries as one entry by debited future contract and gain on future contract credited by 880 instead of record it as separated entries. Let us move to calculate the gain or loss of holding the inventory itself. Here, the spot rate on June 1st is 622. It has been dropped from 640. So because of holding the inventory, we have loss. You have to calculate it. Now the prices has been dropped from 640 to 622, or here already we calculated part of this difference in a previous month in May. You have calculated we have calculated the difference from 64 to 628. Here we calculate the difference from 628 to 622. It has been dropped because of holding the inventory. So again we are talking about loss of 480 because we holding the inventory and the prices has been dropped from 628 to 622. So we have loss by $480. Let us move to record it. Loss on inventory 480. Inventory of hugs has to be declined by 480. The same thing on July 1st here. Let us see. The prices has been declined from 65, the future price, to 610. So again we have gain because of entering into future contract. Here we are talking about 3,200 in total, but again be careful. Already we have recorded 2,080, that coming from 880 from June and 1,200 from May. So you have to deduct it to recognize the amount of gain of July. So only in total 3,200 minus 2,080, the accrued amount from a previous period. So in July we are talking about 1,120. You can record it. Future contract debited by 1,120. Gain on a future contract credited by 1,120. And also you have to calculate the amount of loss on inventory, 960. Here we are talking about the difference from here to here, 622. Because we hold it, you have to adjust it according to the prices, because as we agreed minutes before, we have to calculate it according to fair value because it's associated to a future contract. Here we are talking about dropping the prices from 622 to 610. So we have loss by 960. You have to record it. Loss on inventory of hugs 960 and 960. So again, briefly, on the date or after passing 1 month, we have recorded the gain or loss amount of inventory, gain or loss amount of derivatives. In the coming periods also the same thing, you have to calculate it. Now let us see on the date of settlement. On the date of settlement, you have to deliver the goods that you are agreed to sell it, and you have to receive the cash against these goods. Here we have settled it. We have settled the future contract. When we settle the future contract here, let us move back to the example. On July 20, here, assume the contract are settled on July. Settled, it means we didn't receive and pay. We only settled the difference. Here we have gain. Already we have calculated. Here we are talking about 1,200. Here we are talking about 880 plus 1,120. So in total, 1,200 plus 880 plus 1,120. We are talking about 3,200 as gain. We have to collect it from the counterparty that we entered into a future contract with. So he will pay us the amount, or he will settle the amount of future contract. 3,200 we will receive from him to settle the future contract. Here, after we record this entry, the future contract will be, the balance of a future contract will be 0. On the other hand, we settle, or sorry, we sold the inventory on July 20 by 0.611. By 0.611, we have sold it. We have sold 80,000 units. How we will record it? Cash will be debited by 48,880. The amount is 80,000 pounds multiplied by 0.611. So in total, we will receive 48,880 because we sold our inventory on July 20. 5 days later on, settle the future contract. Here we are talking about separated transaction. We sold it by 48,880. On the other hand, you have to record the entry of inventory as we use perpetual inventory system. Here, cost of goods sold will be debited, inventory will be credited because inventory is assets and assets is declined because we sold it. So it will be credited by the amount of cost, and the amount of inventory will be allocated to the amount of cost of goods sold. Here, be careful. What's the cost of inventory? As mentioned before in the example, the cost of inventory is 40,000, but as it's associated to a future contract, you have to deduct the amount of it. Here we have deducted it many times by 960, by 480, by 960. In total, we are talking about 2,400 already has been deducted. So it's not 40,000. 40,000 minus the losses that has been occurred on the previous period. So here we are talking about 2,400. How we calculate it? 960 plus 480 plus 960. We have loss by 2,040. So cost of goods sold, not 40,000 as the cost of inventory, but you have to deduct the amount of loss. Here we are talking about 37,600 debited to cost of goods sold and 37,600 credited to inventory of hugs. Here, I hope the idea of fair value hedge is clarified. In the coming video, we will move to discuss another example. Let us see you there.